Depreciation of non-current assets. Most non-current assets lose value over time. Depreciation is the term used for this loss of value in the expected working life of a non-current asset. Since this loss represents the cost of using the non-current asset in order to generate profits, depreciation is charged annually to the income statement in the form of an estimated figure. There are three methods for calculating depreciation. They are the straight line method, the reducing balance method, and the revaluation method. Note: since the figure for provision for depreciation is only an estimation, do not use decimals. Round off to the nearest whole number. Reasons for depreciation and provision for depreciation. Note: the reasons for depreciation are different from the reasons for a provision for depreciation. Read your question carefully to discern what has been asked. Let us look at the reasons for depreciation. Depreciation of a non-current asset is caused by any of the following: wear and tear, obsolescence, technological advance, passage of time, depletion, or economic reasons. Now let us look at reasons a provision for depreciation is made. A provision for depreciation is made annually for the following reasons. First, to spread the cost of the non-current asset over the years it is used. Second, so that the income statement shows a true and fair view of the expenses for the period. Since the asset is being used to generate income, a figure representing the cost of this asset should be charged to the profits of the period in question. This is in keeping with the matching concept or principle. Third, so that the statement of financial position shows a true and fair view of the non-current assets. The prudence concept or principle states that assets should not be valued too highly. The provision for depreciation is deducted from the historic cost of the non-current asset, and hence the assets are shown at a net book value, which is a more realistic figure compared to the cost of the asset. 4. Since the provision for depreciation reduces the profit for the year, it is not overstated and therefore is also in keeping with the prudence concept or principle. 5. Since the profit for the year is understated to the extent of the provision for depreciation, the owner is not encouraged to make excessive cash drawings, which would be detrimental to the business. Let us now look at the first method for calculating the provision for depreciation of non-current assets, the straight line method. This method is also known as the equal-installment method or the fixed installment method. As the name suggests, an equal amount is charged to the income statement every year as provision for depreciation. A certain percentage of the cost of the asset is normally charged. However, in the absence of a given percentage, the following formula can be used. Annual installment for provision for depreciation is equal to cost of the asset minus residual value divided by expected years of use. Note: the residual value or scrap value refers to the value the asset will have at the end of its life. Sometimes the asset is valueless. Hence, if the residual value is not mentioned in the question, assume that it is a zero. Now let us look at the second method for calculating the provision for depreciation of non-current assets, the reducing balance method. This method is also called the diminishing balance method. The annual depreciation installment decreases as the asset becomes older. A certain percentage, the calculation of which is not in your syllabus, is used on the net book value, also known as the carrying amount of the asset at the end of the year, and this is the amount charged to the income statement as provision for depreciation of that non-current asset. Let us now look at the third method for calculating provision for depreciation of non-current assets, the revaluation method. When full accounting records are not maintained, the revaluation method of depreciation is used. Assets are valued at the end of each year. The reduction in the value of the asset at the end of the year compared with its value at the start of the year is the depreciation of that asset for the year. For example, on the 1st of January 20x5, the value of loose tools was $450. On December 31st, 20x5, the value was $350. Hence, the provision for depreciation of loose tools for the year ended 31st of December 20x5 was $100. Note 1. The closing value of loose tools in the above example, $350, will be shown as inventory of loose tools after the usual inventory in the current assets section of the statement of financial position. Note 2. If purchases were made during the year, these purchases are added to the opening figure. The closing figure is then subtracted to arrive at the provision for depreciation of that asset for the year. Let us look at what happens when a non-current asset is said to be impaired. When an event occurs that significantly reduces the life of a non-current asset, as a result of which the asset's net book value is more than its disposable value, then the asset is said to be impaired. The procedure to follow in such an event is to reduce the net book value immediately to its recoverable value, also known as the carrying amount. The reduction is treated as a loss, which is then charged to the income statement as exceptional depreciation. Annual depreciation is then recalculated, taking into account the new carrying amount, which is divided by the remaining useful life of the impaired asset. This is an excerpt taken from my book, Revising AS Accounting, a Study Guide. A car was purchased in 20x1 at a cost of $23,000. It was presumed at that time to have a useful life of 10 years with a residual value of $4,000. Depreciation was to be provided in the year the car was bought, but not in the year of disposal. Using the straight line method, we calculate the annual provision for depreciation installment to be $1,900. Therefore, the net book value of the car on the 31st of December 20x3 was $17,300. Continuing with the example, in 20x4, it was found that the car had a recoverable value of only $10,000. This asset is therefore impaired, as the net book value, $17,300, is much more than its carrying amount or recoverable value, $10,000. Hence, the income statement will be immediately debited with $7,300, the difference between the net book value and the recoverable amount. Looking further into the example, if the car now has a useful life of 4 years with no residual value, what should the annual depreciation be for the next 4 years? Using the straight line method, the annual depreciation provision would be $10,000, its new carrying amount, divided by 4, the years that are left of its useful life, which gives you an annual provision for depreciation installment of $2,500. What happens when an asset is disposed of or sold? When an asset is sold, we need to delete it from our records. Entries to that effect will be made in 3 accounts: the asset account, the provision for depreciation account, and the disposals account, which is opened and closed when an asset is sold or disposed of. The disposals account usually has the following entries. On the debit side, the asset at cost price and the profit, if any, made on the sale or disposal. On the credit side, accumulated depreciation, cash received on the sale of the asset, or the value of part exchange of an asset, and the loss, if any, made on the sale of the asset. Part exchange. When a new asset is acquired, it may be acquired in part exchange of a used asset being disposed of. The part exchange value of the asset being disposed of is debited to the non-current asset account and credited to the disposals account as the proceeds of disposal. Exhibit. Pause your video and read through the exhibit carefully. Solution. The motor vehicles account will have the following entries. On the 1st of Jan 20x2, the balance in the motor vehicles account was $22,000. On July 3rd, this account is credited $22,000 on the disposal of the motor vehicle. On the same day, the motor vehicle at cost account is debited $30,000, being the price of the new motor vehicle acquired, comprising of a part exchange of $7,000 and a check payment of $23,000. Let us now look at the provision for depreciation motor vehicles account. On the 1st of Jan 20x2, on the credit side, the balance brought down was $18,000, which was accumulated depreciation for the motor vehicle being disposed of. This is now closed. The provision for depreciation of motor vehicles account is therefore debited on the 3rd of July with $18,000. Let us look at the motor vehicles disposals account. On the debit side, on the 3rd of July, you have the cost of the motor vehicle being disposed of, $22,000. Let's look at the credit side of the motor vehicles disposals account. Accumulated depreciation is $18,000 on the 3rd of July, and the part exchange of the motor vehicle $7,000. On balancing the disposals account, you will notice that there is a profit on disposal of $3,000. This is an interesting example adapted from a past paper. Pause the video for a while to study all the information given carefully. Let us start with the working. Working 1. To calculate the provision for depreciation of buildings only for the year ended 31st March 2016. It works out to 2% of $252,000, the historic cost of land and buildings, minus $182,000, the historic cost of only land, to give us $1,400. Working 2. To calculate depreciation for plant and machinery for the year ended 31st March 2016. Machinery purchased on 1st December 2015, 20% of the cost of $62,850. As there is no accumulated depreciation, this is the net book value for 4 months, December, January, February, March, equals to $4,190 using the reducing balance method. Machinery sold on 30th November. This machinery was therefore used for 8 months. Hence, the depreciation for the year ended 31st March 2016 was 20% of $46,350, which is the net book value of the machinery sold. For 8 months, it is equal to $6,180. Provision for depreciation of the remaining $123,000 cost minus $49,000 accumulated depreciation minus the net book value of the machinery sold, $46,350, times 20% to give us a figure of $5,530. Therefore, the total depreciation for the year ended 31st March 2016 for plant and machinery was $15,900. Now, let us draw up the statement of financial position for King as at 31st March 2016. Extract. Working A. Cost of land and buildings is equal to $252,000 original cost plus increase in the land which was revalued to give us $272,500. Working C. Cost of plant and machinery is equal to $123,000, which was the original cost, plus $62,850, which is the cost of the machinery purchased, minus $76,200, which is the cost of the machinery sold, to give us $109,650. When we total up the cost of the land and buildings and plant and machinery as per working A and C, we get a total of $382,150. Working B. Accumulated depreciation of land and buildings is equal to $21,000 original plus $1,400 as per working 1 to give us a total of $22,400. Working D. Accumulated depreciation of plant and machinery is equal to $49,000, which is the original figure, plus $15,900 depreciation for the year as per working 2 minus accumulated depreciation of machinery sold minus depreciation for the year of machinery sold to give us $28,870. Adding the two, that is accumulated depreciation for land and buildings, $22,400 as per working B, and accumulated depreciation for plant and machinery, $28,870 as per working D, we get a total of $52,270 accumulated depreciation. Let us look at the net book value. The net book value for land and buildings is $272,500 minus $22,400 to give us $250,100. Plant and machinery, $109,650 minus $28,870 to give us a net book value of $80,780 for plant and machinery. Adding the two net book values together, we get a total of $380,880. More information about AS Accounting, a study guide. The content of this book matches the latest CRE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the CRE AS Accounting course. Some salient features of the book are: it unpacks the CRE AS Accounting syllabus, IAS terminology has been used, students love the unique question and answer presentation of theory, there are numerous tips for success, and exhaustive exercises for practice. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.